to the Borosil Q1 FY26 earnings conference call hosted by ICICI Securities Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star and then zero on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Anirudh Joshi from ICICI Securities Limited. Thank you, and over to you, sir.
Yeah, thanks, Nidhi. On behalf of ICICI Securities, we welcome you all to Q1 FY26 results conference call of Borosil Limited. We have with us today senior management represented by Mr. Shrivar Kheruka, Managing Director and CEO, Mr. Rajesh Kumar Chaudhary, Whole-Time Director, Mr. Anand Sultania, CFO, Mr. Rituraj Sharma, President Consumer Products, and Mr. Balesh Talpadi, Vice President Investor Relations. Now I hand over the call to the management for the initial comments on quarterly performance. Then we will open the floor for question and answer session. Thanks, and over to you, Shrivar, sir.
So thank you, Anirudh and ICICI Securities for arranging this call. Good afternoon to every one of you. We are all delighted to be communicating with you once again. I'm pleased to inform you that Borosil Limited's board has approved the financial results for Q1 FY26 during our meeting on 14th August 2025. We've submitted our results and an updated presentation to the stock exchanges, and they're also available on our company's website for your review. I'm pleased to report that Borosil Limited has delivered a steady performance in Q1 FY26 with consolidated revenues from operations reaching 232.7 crores, up from 221.2 crores during the last year. This represents a 5.2% year-over-year growth. This steady growth, achieved against challenging market conditions, reflects the resilience of our business model, the strength of our execution, and the continued trust and loyalty of our customers. This also places us on a strong competitive footing alongside our peers. In Q1 FY26, the company achieved an operating EBITDA before investment income and one-time items of INR 40.2 crores, up from INR 34.6 crores in Q1 FY25, which is a 16.1% year-on-year growth, reflecting our continued focus on efficiency and growth. The operating EBITDA margin for Q1 FY26 stood at 17.8% versus 16% during the last year. Other operating income includes INR 6.03 crores from shared service support income for Q1 FY26 and INR 4.21 crores for Q1 FY25, with the associated expenses captured under total expenses. Profit before tax for Q1 FY26 was INR 23.5 crores, up from INR 12.9 crores in Q1 FY25. Q1 FY26 includes a one-time stamp duty expense provision reversal relating to demerger of INR 7.2 crores, which is shown under the head other income, and also includes one-time expenses of INR 1.6 crores towards professional fees for a strategic assignment. The net impact of one-time items is INR 5.6 crores. At the same time, during Q1 FY26 as compared to Q1 FY25, depreciation has increased by INR 2.6 crores and finance costs decreased by INR 2.7 crores, largely due to repayment of debt. The profit after tax grew from INR 9.3 crores in Q1 FY25 to INR 17.4 crores in Q1 FY26, which is a growth of 87.4%. As on 30th June 2025, Borosil Limited has a net debt of INR 5.1 crores. Now let's take a closer look at our category-wise performance for this quarter. Borosil's consumer division continues to expand across both glassware and non-glassware categories under the Borosil brand, along with our opalware range under the Lara brand. The Lara opalware segment reported sales of INR 76.2 crores in Q1 FY26 versus INR 76.1 crores in Q1 FY25. Lara's performance in this quarter mirrors the overall market softness during the quarter, with sales impacted by slower demand. However, we expect a strong recovery in the following quarters. In our glassware segment, which includes microwavables, servingware, glass tumblers, lunch boxes, and storage solutions, we recorded a muted year-over-year growth with revenues reaching INR 56.2 crores compared to INR 55.7 crores in Q1 FY25. As mentioned in the earlier quarters, our performance was also influenced by UCPMP 2024, which restricts incentives to healthcare professionals, This weighed on our B2B business by curbing bulk orders and limiting distributor engagement. The non-glassware segment, encompassing a wide range of small home appliances, insulated bottles and flasks, cookware, and other kitchen essentials, performed strongly, posting a 10.7% increase in revenue. Turnover for this segment reached INR 94.2 crores in Q1 FY26 compared to INR 85.1 crores in Q1 FY25. BIS compliance requirements affected our Hydra bottle sales, as some of the channels are only accepting BIS certified steel products. Our team has recognized these headwinds and is actively reshaping the overall strategy to mitigate this impact. As part of this, in the previous quarter, we had announced the establishment of a new manufacturing facility in Rajasthan through our wholly owned subsidiary, Stylenest India Limited, for vacuum insulated stainless steel flasks, bottles, and containers. This safe and durable products, exactly the space that Borosil as a brand operates in. Secondly, the accelerated rejection of plastics, concern around BPA, microplastics, and other harmful chemicals are prompting consumers, especially urban millennials and Gen Z, to move away from plastic. Add to that government-led single-use plastic bans and growing sustainability awareness. This would make the shift towards materials like steel, glassware, and opalware inevitable. We are excited about the Indian lunchbox market as well, which is worth more than 4,000 crores. More and more consumers are looking for safer, microwave-friendly, and sustainable options. This is exactly where Borosil has an edge. Our premium glass lunchboxes combine toughness, leak-proof performance, and microwave compatibility, all in a product that looks great and is built to last. This is also one of our hero products. One of the pillars of our long-term strategy is our commitment to Make in India. We already operate one of the largest opalware capacities in India with 84 tons per day, and India's only 25 ton per day borosilicate glassware plant, which we commissioned in March last year. But we're not stopping with glass. As already mentioned, we are now expanding our manufacturing footprint with a new facility being set up to producing vacuum insulated stainless steel bottles, flasks, and containers. Borosil is on a transformational journey to address key ESG opportunities and create long-term value for all our stakeholders. One of the strategic priorities of ESG is to lower our operational carbon footprint and meeting decarbonization targets. Borosil has successfully commissioned 2 captive solar power plants in Bikaner, Rajasthan, with a capacity of 8.6 megawatts commissioned in December 23 and 7.2 megawatts commissioned in September 24. The existing plants cater to approximately 30% of our overall power consumption. The recent introduction of Green Energy Open Access Regulations 2025 permits further expansion of our solar capacity. As a result of this, the company will be further investing about INR 75 crores in the current financial year towards expansion of our solar capacity by setting up another 20 megawatt captive solar plant in Bikaner. The project shall be funded with an appropriate mix of debt and equity and has already been approved by our board of directors. Borosil is at the forefront of India's shift towards healthier, eco-friendly kitchen solutions, replacing plastic with microwave-safe, BPA-free glass and stainless steel products. Rising disposable incomes and growing health awareness are accelerating this transition, and we are successfully converting plastic users to glassware and opalware. With aspirational designs, educational marketing, and an emphasis on hygiene and elegance, Borosil is redefining the modern Indian kitchen. Our omni-channel presence across general trade, modern retail, leading e-commerce platforms, along with strong B2B and export channels, have delivered deep market penetration. Today, with products available in over 24,000 retail outlets, we have built a diversified revenue base that connects with both urban consumers as well as international markets. In summary, despite near-term challenges, Borosil's strong brand equity, diversified portfolio, expanding manufacturing base, and omni-channel reach position us well for sustainable growth. Thank you for listening, and I would be happy to take your questions.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we'll wait for a moment while the question queue assembles. The first question is from the line of Sukrit D. Patil from Eyesight Fintrade Private Limited. Please go ahead.
Good afternoon, Mr. Shilpa. My question is, as Borosil's non-glassware portfolio now contributes over 50% of the brand revenue, how are you planning the next phase of brand evolution, particularly in expanding into adjacent categories like smart kitchen appliances, sustainable cookware, or even, say, modular dining solutions? Is there a roadmap to position Borosil as a full-stack home utility brand beyond its legacy in glassware modules? Yes, thank you.
Yeah, thanks for the question. Look, as far as our brand is concerned, we continuously look at kitchen as a whole, and the table serving and even on the go storage as a whole category, to evaluate where our products, or where we should launch products. As a part of that, not only do we evaluate the size of the market, we also look at trends and growth rates as well as the competitive intensity of these markets. So definitely, there is a future in which we could consider modular kitchens as an example, although that's not something we are doing right now. But we do have other categories which we have focusing on this year. For example, gas stoves is one such category where we've done quite well this year. And this is let's say in the last 12 months we've launched a product which has been reasonably well accepted already in the market. We'll also be launching products in, say, dinnerware like porcelain this year. But this is a continual work in progress, and I believe that we have a very strong team which understands trends quite well and is also able to develop products to meet those trends. So yes, to answer the question, we would be looking into the whole kitchen and and the table as a market opportunity. We do believe that we are an everyday use brand, so people who like quality but also want to have a good life, everyday use product where they feel happy to use these products. There's a design aspect to it, there's a convenience, there's a force multiplication aspect to it. That's the kind of brand positioning that we aspire to, and the product categories will keep coming. New and new innovations will keep coming. But specifically, I don't believe that we are launching modular kitchens per se at this time. But we'll keep looking at new categories.
Great, thank you very much. My second question is to Mr. Anand. I believe he's on the line. Yes.
Yes, I'm there.
Yeah. Hi. Good afternoon. My question to you is, as Borosil scales across the different categories and the channels, I would like to understand how do you internally prioritize capital between product innovation, digital distribution, and inorganic growth. Is there any kind of a framework that balances near-term margin impacts with long-term brand and portfolio diversification? Yes, thank you.
No, so as far as the capital allocation is concerned, we look at basically each category, like the glassware, within the glassware, the pressware, as well as whatever is procured from the scientific business. And then within the non-glassware, you have other categories like your Hydra and then your appliances, as well as your Seal Serve Fresh, and of course Lara, which we acquired in 2016. So the capital allocation, depending upon the size, the scale of the business, and the requirements of the business, probably is allocated. We have a very detailed in-house study probably that we do on a monthly basis. Sorry, what is your next question?
So I just wanted to understand how do you decide to where to allot your major chunk of the capital? Is it between product innovation, digital distribution, or inorganic growth? What is the plan of action that you follow? I just want to understand that.
No, so the capital allocation is on the basis of the ROCE that the potential business can generate, and that is the way probably the capital is allocated.
Okay, fine, no worries. Thank you very much.
Thank you. The next question is from the line of Mohit Jangir from Invade Research. Please go ahead.
Yeah, first of all, congratulations on this set of numbers. Sir, my first question is on the non-glassware side, as we are doing CapEx in stainless steel flask. So what kind of margin expansion do we expect post the commercialization and optimum utilization of the unit? And how much of demand do we have captively, and are there any plans for external sales of stainless steel flask? And any plans for further CapEx in non-glassware segment in further product categories?
Okay, well, thanks for that. As far as our demand is concerned, our entire capacity will be for internal consumption only, because I think we have more demand than supply at the moment. As far as margin expansion is concerned, it's a dynamic market right now, because there's anti-dumping duty, which is there in play for steel as well. So that's for the raw material, and as well as there are certain, let's say, pricing that the competition is offering in the market. So I would say that the exact margin expectation would be very clear only in the next 3 to 6 months, as the market kind of settles with this ADD which has come. Hard to give a exact number for that. As I've always maintained that our ROCE expectation will be north of 20%, and that's what we expect to achieve even here in this stainless steel category. But obviously there's also a learning curve. It's the first time we are making steel, to get the full efficiencies to the level that that say more established players who have been doing this for quite a few years achieve, may take us a couple of years. But I think if I look at it from a couple of year, 2-year horizon, I definitely expect that we will achieve that 20% plus ROCE.
Okay, and sir, any plans for further CapEx in non-glassware category in any other product segment?
At this moment, when there's a plan, we'll update you. But right now, this is the category that we are focused on.
Okay. Sir, my next question is on the EBITDA numbers or any margins that you can tell in opal or glass segment, and are there any plans to demerge opal plus glass into one company and non-glass into other? And what is the capacity utilization of a borosilicate glass unit?
Yeah, we don't share the margins by category, so I'm sorry I can't share that with you. And there's no plans to do any structural changes in the company. We're very happy where we are. And as far as the capacity utilization is concerned, I would say we are lower than expected this year because of muted first quarter sales. So opalware may be around 80% capacity utilization. Glassware may be around 50, 60%, 65%, I would say, capacity utilization. So we do expect to rebound in the next 3 quarters. And opalware, we would ideally like to go to closer to 100%. And glassware, if we can cross 80%, it will be very good for us.
Okay, thank you.
Thank you. Before we take the next question, I would like to remind the participants, anyone who wishes to ask a question may press star and 1 on their touchtone telephone. The next question is from the line of Akshat Mehta from Seven Rivers Holding. Please go ahead.
Hello, sir. Am I audible?
Yes.
So first question is on the revenue side, sir, that we were targeting 15 to 20% revenue growth this year, and we've come up with 5% in this quarter. How should we look at, the revenue growth for the rest of the year, and, what would be the key drivers for that?
So just to correct you, I think when we speak about revenue growth, we have always said over a 3-year period, and it's never any projection for a single year because there are many factors which can happen in any quarter or any year which can derail that. A case in point being COVID. But coming back to your question, I don't believe there's any change in our medium-term revenue CAGR of 15 to 20%. I'm still quite bullish that we'll achieve that. We are launching, as I mentioned before, new categories which we've done this year. Although obviously new categories take time to establish, but even in our existing categories, I think the first quarter has been challenging for the whole industry, and not just kitchenware and tableware. If you look across the board, consumer demand has been muted. So it's a reflection of that, and we do have, 2, 3, 4 quarters sometimes in a row like this. But I don't expect that to derail our medium-term growth, and we do hope to rebound in the next few quarters as well. But I can't give you a specific, number for this year. Hard to predict. So yeah. Sorry, is that the question? Did I miss something? So this was the question.
Yeah. Sorry, sir. So, is there a doubt that we can grow 15%-20% for the full year? Any near-term demand drivers that you see that can help us grow, better than quarter one?
Yeah, there's no doubt that we'll grow. But putting an exact number this year is hard to say. We still hope that we'll, continue our growth trajectory as we've been having in the last few years, this year as well. But there's no guarantee of that. The demand driver is there. I mean, Prime Minister has announced a GST rationalization, on 15th August. We need to understand how that will impact our goods. If GST comes down, on any of our products, definitely that will be passed on to the customers, and definitely that will be a demand driver. Plus, of course, the income tax, scheme which was passed in the budget will also be a demand driver. So those two, from a macro perspective, are demand drivers. Obviously, any positive impact of customer sentiment will also be a good demand driver for us. So these are all generic things I'm saying, and is applicable to probably all consumer product companies. But we, with our view, from our side specifically, I would say, we keep looking at marketing as a demand driver for us. Product introductions as a demand driver for us, and those are continuing as before, and nothing has changed compared to last year or the year before. So we don't expect to have a poor outcome. We are still gunning for that growth, as I already shared. Whether we'll get exactly that this year, it's hard to predict.
Okay, sir. Second question would be on the margins. This on a year-on-year basis, we've seen glassware and opalware being almost flat, while non-glassware has grown by 11%, which is a comparatively lower margin category. I just want to understand how have we managed to grow our margins by more than 200 bits on year-on-year basis. What are the drivers for that, and how should we look at the margins from a full year perspective as well?
Again, I won't answer for this year. In principle, we have always indicated that in the next 2 to 3 years, we should hit a 20% EBITDA margin. And that's something that we have said many times in the past, and we stick to that. So it's a part of that journey. As far as the margin expansion, I did cover it in my call that we had some, savings in power and fuel expenses, as well as rationalization of marketing spend, and more specifically towards performance marketing spend this year. As we get better at targeting customers, we are able to reduce our overall marketing expenditure to that level. So these are the two main drivers for the margin enhancement. Even though actually as you rightly pointed out, the product mix from a margin perspective is actually worsened for us, given that the sales increase has come largely from products which are lower margin.
Okay, sir. Can you share what has been the loss of sales in pharma due to the new gifting regulations that have come in this quarter?
It's hard to say for this quarter. But overall, I think more than 50 crores per year we were doing in that segment.
Okay, sir. Thank you. I'll come back.
Thank you. A reminder to the participants, anyone who wishes to ask a question may press star and 1 on their touchtone telephone. The next question is from the line of Bhavin Rupani from Investec. Please go ahead.
Yeah, hi sir. Thank you so much for the opportunity. My first question is related to Hydra. In the last call, you mentioned about risk of going out of stock due to lack of outsourcing partners in India. Would you like to throw some light here on our progress on getting new outsourcing partners on board?
Yeah, I think that's been a success story. We have been able to get more and more suppliers on board. I would not say we are where we need to be. We are still not able to procure as much material as there's demand for, and that sale loss will be there this year from that category. However, the quantum of sale loss is likely to be substantially less compared to what we had originally thought, because of our ability to onboard new suppliers. I don't want to get into detail of, because these things are fluid, and also the issue is, frankly speaking, that the predictability of supply is still lacking, because some are able to deliver more in 1 month than others, and they also have challenges, ramp-up challenges. So it's hard in the first couple of years to have a very predictable answer in terms of how much we'll actually get, because even the suppliers are struggling to kind of streamline their manufacturing. But overall, I would say the prognosis is better than where it was 3 months ago, and will likely improve further in the next 3 months.
Got it, sir. What I understand is this category is SKU-driven category. So can you please tell us how many SKUs we have introduced recently from this outsourcing partner, and what are the plans going ahead?
I don't want to get into details of how many SKUs have been introduced, but overall, I think we have close to 100 SKUs, if I'm not mistaken, in this category. But that's too much information to share at this stage.
Got it. Fair enough, sir. And sir, on A&P spends, historically, our A&P spends has been in the range of 7.5 to 8% of sales. Do you think we'll continue to maintain similar run rate for the year? You did mention that in Q1 we had reduced it, but what are your expectations for the full year?
So, look, A&P has two types of spend. One is a general brand spend, which will not reduce, and second is performance marketing spend, which depends on your efficiencies and your learning of how to draw in more customers or get more bang for the buck. So on the brand spends, we will not reduce even 1 rupee. If anything, will be increased. But on the performance marketing spend, as we get better, naturally the percentage will come down. And that is what we are seeing. So we've been, our team has been continuously learning, and I think we've done quite a good job there, and we'll continue focusing on that. What it means overall is that the spend may come down by 1 or 2 percentage points over the overall, 8% spend may come down to, say, 6.5% of our sales.
For the current year, you are saying?
Again, look, these numbers may go off. Again, it's hard to say because these are tactical calls you take on a daily basis. And when we are talking about taking tactical calls, at that time we don't worry about what we've told our investors, because we do what we need to do for the business. So it's hard to say for any one current year, but in general, yes, that's a trend which will happen, that 8% will come down to 6.5%.
All right.
If you can achieve it in this year, we'll be very happy. Yeah.
Got it. So next question is related to power and fuel. You did mention that our cost reduced from 20 crores to 17 crores this quarter. Can you please help us understand what could be the annual savings from solar projects on our current capacities right now? And are there any possibilities of further cost reduction for the full year?
So 13 to 14 crores per year, this year we will be getting as a saving overall. Although the projects were there even in play last year, so it cannot be compared to last year. It's compared to maybe the year before, I would say. But the other point is that with the new power and fuel, the new solar project, that number will add up to another 17, 18 crores. So the number will go to 30, 32 crores per year saving, compared to not having done this project.
So, sir, post this new capacity that we have announced in solar, our power and fuel will be 100% renewable?
It will still be 65% renewable, although there will be a roadmap to get to 100% in the near future after that again. So right now we're at 30%, we'll go to 65 with this project, and then we'll do a phase 4, which should take us closer to 100.
Got it. Fair enough, sir. And sir, our gross margins, if you look at, we have it has declined by almost 200 to 20 bips year on year. How should one understand this? Is it due to additional incentives in the market to push volumes?
No, it's a product mix issue. It's purely a product mix issue. We have not increased the discount on any product.
All right. So also our channel checks indicated there was a demand continues to be tepid in Q2. So have we increased our incentives for the channel partners to make it more attractive for them, or we have increased any discounts? No increase.
No. Okay. Normally Diwali has discounts which are anyway there every year, and those Diwali discounts will happen this year also, but there's no increase. It will be the same level as last year.
Got it. And sir, CapEx guidance for the year? So 75 plus 40, 110 plus some maintenance?
Yeah, maybe 125, 130.
Got it.
125.
That's it from my side. Yeah, got it, sir. Thank you so much.
Thank you. The next question is from the line of Vipul Kumar Shah from Sumangal Investments. Please go ahead.
Hi, sir. What is our market share in opalware segment?
I think you can calculate that yourself, because our competitors are listed, and I believe that the numbers are available for everybody, but my sense is about 30%.
Okay. And so this new steel flask facility, when fully operational, what type of annual revenue we can expect from that plant?
So phase 1 will be about 120 crores, and there will be a phase 2 after that also, which we have not announced yet, but we will do that shortly.
So in phase 2, there will be another capex, right?
Yeah, that's right. There will be more capex.
Okay, but for this 40 crores, we'll be getting around 120 crores of revenue.
Yeah, that's right.
Thank you, sir.
Thank you. The next question is from the line of Rakesh from Nine Rivers Capital. Please go ahead.
Hi, team. Thank you for the opportunity. Sir, couple of clarifications on the annual report. First part, in the annual report, we have mentioned the company has plans to raise 250 crore. It is just an enabling resolution, or we have intention to raise in the coming years?
Yeah, we take this every year as an enabling resolution, and likely it will not be utilized.
Okay. Thank you, sir.
And second, it's taken from the point of view that sometimes you have acquisition opportunities or some interesting things that come up in the middle of the year. In the past, we had that, and then it delayed everything by having to take this resolution, and that's why we take it as an enabling one only. And unless something interesting comes up, it won't be utilized.
Okay, that's very helpful. Second clarification with respect to the subsidiary, that is Alpha Realty Limited, a company wholly owned subsidiary that is into business of real estate, and they are thinking to expand in that business. Anything on that business, sir?
No, I'm not sure where you read that we are looking to expand that business. That business is not a business. There's some parcel of land which the company owns, and there's a certain, let's say, approvals which the company has in its name. So when we sell that land, which is historical land owned by the company for the last 60 years, 70 years, or 60 years, that time you have to sell the company because the approvals are in the name of the company and can't be changed. So this is only an enabling way to sell that land, which is the historical land of the company, and there's no plans of the company to enter any kind of real estate business at all.
That's very helpful. So just one last clarification. In the annual report, as you mentioned, the company has installed 7.27 megawatt of solar plant. That is the plant. That is the plant you were talking that in the initial remark you talked that we are going to sell 12 to 15.
Yes, that's phase 2. Phase 1, there are 2 phases which are already installed, and phase 3 now we'll do.
Okay. So currently, we because of the solar plant implementation, we'll be saving 12 to 15 crore in the power cost. And once the phase 3 comes also, then we'll be saving additional 15 crore from that phase 3. Is that understanding correct?
15 to 18 crores, yeah, in phase 3.
Yes. Yes, sir. Thank you. Thank you very much. That was very helpful. Thank you. Best wishes.
Thank you.
Thank you. The next question is from the line of Resham Mehta from Green Edge Wealth. Please go ahead.
Hello.
Yes, please, carry on.
Thank you for the opportunity. So I've joined a little bit late. So if my question is repetitive, then I can, refer to the transcript for the first question, which is basically what has been the reason for, muted growth in glassware and opalware?
I mean, I think market sentiment in general has been quite weak. So that has been, I would say, the main reason for the muted growth. There were no marriages or very few marriages, let's say, in this first quarter. Opalware, there's a lot of gifting for that. We have this UP, CMP, pharma guidelines, which prevent gifting to end users of the pharma products, which has traditionally been a market of one of our, let's say, channels, which has not had much sale. In Q1. These are the two main, reasons. Although, we look forward to a better Q2, Q3, and so on.
And this pharma channel rule change, right? So when does that, come into the base quarter?
I think from Q2 onwards.
Q2, okay.
So I think Q2 onwards last year we had a problem with it.
Right. And as far as your ad spends go, what's the split between ATL, BTL? Broadly at 8%, but there's a split between ATL, BTL?
I'm sorry, I don't have the exact answer for it, but I think most of it is ATL.
Understood.
I
And,
can check. Yeah.
Sure. And I have a couple of questions on your sales and distribution, right? So one is, how successful, have we been? So broadly, we have three categories, right? And a lot of these have overlap, at least at the end retail counters. So what is, the kind of, penetration that, we had achieved for opalware, non-glassware, with our glassware channel partners, retail outlets? And how do we, look at expanding this universe of 24,000 retail outlets? So as I understand, the reach for the kitchenware space is around 1 lakh outlets, but how do we see, the path to this 24,000 outlets to 1 lakh outlets? Or do you think that, because our positioning is a little bit on the mid-premium side, maybe for us the universe is not 1 lakh outlets, it's far lower. So if you can just kind of, give some qualitative thoughts or otherwise on this.
Yeah, maybe I don't know if Mr. Rituraj Sharma is on the call. Okay, I think he's missing the call at the moment. But okay, then I'll take a stab at it. So as far as the numbers, I'll address the number of outlets. The number of outlets which we have are 24,000. These are, just to be clear, these are outlets that we routinely bill to, because we have data of billing of each and every outlet on a daily basis. Okay. So these are outlets where we have done billing consistently and have billed at least once in the last 3 months, if I'm not mistaken. Now, if you look at the total outlets that we bill, could be more than 38,000 already. But we don't put that in because there would be quite a few outlets which are billed once in a year or billed, infrequently, and therefore we don't classify that as a regular sale outlet for us. So to answer your question, I believe that we do have a plan to increase this 24,000 to about 45,000 in the next 3 to 4 years, and I believe that's a realistic goal to achieve. And I believe that we will get there with our increased penetration as well as product portfolio enhancement and so on. But yes, I don't believe that 1 lakh we could reach, because a lot of those outlets are rural and of a nature where the product categories are not relevant to our current profile. As far as the success of cross-selling, this is something we measure quite actively. And I believe that if you see the proof of pudding is frankly in the eating, and if you see the dramatic increase in sales of our non-glassware, it kind of gives you a very, reasonable understanding that our cross-selling has worked. And many of the 24,000 retail outlets, actually new outlets, which have picked up selling our non-glassware range, and that's the reason we are where we are today. So I think the effectiveness of having this broad product range has definitely translated into more, so many more outlets buying a larger range of our products. And I believe our retailers are also making better margins from us, in the sense that they are earning a higher percentage of their profit from us, which also kind of, is a good symbiotic relationship to have with them. And we do have software, or rather which tells us how many outlets are selling which product and how many outlets we've been able to convince them to sell more of our or multiple ranges, and all the numbers look quite encouraging. So we are quite positive on that aspect, and I believe that steadily 2,000, 3,000, 4,000 outlets per year we should be increasing over the next few years.
And are we also able to track, since you spoke about some of the tech tools that we have, so are we also able to actively track the secondary sales?
Yeah, of course. We track. We have a daily tracking.
And now that since we have a wide product range and multiple categories, how are we thinking about, probably getting into exclusive brand outlets, or maybe just what are our thoughts there?
This is something we're considering. We are working on it. We're actively figuring out how to do it, when to do it, what is the cost, what is the return, how to look at the costs. It will take us a little bit of time, but I do believe we'll have something on this account soon.
Right. And just the last one. So you spoke about the muted demand. Can you just call out if there are any deviations or different trends if you're seeing them across different channels? Of course, general trade, I think, is commonly known that there it's more muted. But what about CSD, exports, some of these channels? If you can just highlight the demand there.
Yeah. So look, overall, I would say e-commerce, quick commerce, large format stores are doing quite well. As you already noted, general trade is impacted, and given that it's the largest percentage of our sales, it has a disproportionate impact on the overall, let's say, trade, overall sales. But the worst hit has been the B2B business, which I already mentioned, as because of this pharma, the pharma regulation which came into place last year, followed by trade, and then exports. Frankly speaking, we have a very low penetration in exports, so it's not worth discussing because the base itself is super low. I think trade will bounce back. We're already seeing some green shoots there for Q2 and onwards. So I do believe that we'll see a smart bounce back in this, and this demand will pick up quite well in the coming quarters basis. My team's estimate with what's happening as a shape up to the Diwali season.
And CSD?
CSD hasn't been great. There have been challenges in CSD, more from the internal, I would say, internal regulations. Nothing to do with demand. I think their own buying, behavior is changing, and it's a complex organization, CSD, how they decide what in terms of how to buy, what to buy. So we are definitely seeing a negative impact of that.
Right. All right. Thank you. All the best.
Thanks.
Thank you. The next question is from the line of Sumit B, an individual investor. Please go ahead.
Good evening. A couple of questions. First is on opalware. So now that Lara is a core part of the portfolio along with Borosil, and you're reaching almost saturation, you're at about 80-85% capacity utilization. What's preventing us from planning ahead? It will take a few quarters for a new facility to come up to actually go ahead, because there are news about Milton Plastics coming in. So wouldn't you be losing share if we don't actually start thinking about building capacity expansion for Lara? That's my first question.
Yeah, I mean, this is a good question. I will answer this in two ways. Number one is that we have already a plan to debottleneck some of our operations, which will expand our capacity by 10 to 15% in the next year or so. So that itself, that will happen. Second thing is that we ourselves are not at 100% capacity utilization. We're only at 80-85% capacity utilization. And I believe that, we've also built up inventory. So for the next 2 years to grow at, 10 to 15%, we have enough demand. So rather we have enough capacity. And then post that, yes, if we have to grow, we would need to have a third production. But we have seen some demand not being great. So just by putting up capacity doesn't mean we can create demand. You'll only destroy the value of the product. So which we don't want to do. Can't really comment on what competitors are doing, and I think taking strategic calls basis competitors' actions alone would be not the appropriate move. So from our perspective, we feel we have enough capacity to grow at a sustainable growth rate for the next couple of years, post which we'll see how the market trends are evolving and whether to add capacity or not. There could be also, there are other, like we're launching porcelain, which is a more premium offering. It also depends, that is also, because when a customer goes to the market, they don't go to buy opalware, they go to buy dinnerware or servingware. And this is one of the categories premiumization is also a trend we're seeing. So as we expand our sales of more premium products, we may choose to put up capacity in that product segment rather than, rather than the opalware. So there's so many unanswered questions, and I believe we have a year or so easy to take that call. So not rushing into any decision, because any capex will cost 200 crores, and then again we'll be struggling with capacity utilization. So I think best to take a call when we're absolutely sure we have a reasonable chance of selling 60-70% capacity right up front.
Got it. Fair enough. Thank you. My second question was on appliances. Again, this has been a tremendous growth lever for us over.
The line
Hello?
the line for the current participant has got disconnected.
Okay.
As there are no further questions, I would now like to hand the conference over to the management for closing comments.
Okay. Well, thank you all for your involved set of questions. We as a management team are very committed to the business, as we have been for the last many years, and we continue to be so for the coming years. We really appreciate your support as shareholders and or potential shareholders, and we look forward to growing our business aggressively with improved margins as we go along. So thank you, and wish you all the very best for the upcoming festive season.
Thank you very much. On behalf of ICICI Securities Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.